Right, so good evening, everybody. Today we're going to talk about inventory cost accounting in Microsoft Dynamics 365 Business Central. We're going to talk about the various inventory subledgers and the relationship with the general ledger today. We are going to cover expected cost posting and how to configure it correctly because it can be quite tricky sometimes. We are going to learn the difference between direct and indirect costs in Business Central, which also can be quite complex and is quite peculiar, quite specific. Other applications manage those in a very different way. Quickly, we're going to cover inventory revaluation, which can also be very powerful because it can revalue also cost of sales, but only if we do it in a certain way, which again, we will learn later. Landed cost using item charges, a quick introduction to standard costing and variance in manufacturing, which is arguably the most complex area of inventory costing, but where Business Central also works in a very specific way that makes it different from other applications like SAP and Oracle. So something to consider when you work on a new project, if you, like me, are also a consultant. Right, let's get started. So a bit about me. If you don't know me, my name is Alfredo. I am a senior Microsoft Dynamics 365 Business Central. I am a consultant, and I am also a Microsoft certified trainer. I usually work on large projects as a lead solution architect or lead consultant, and I also deliver training through my organization called D365 Training. I hold a few certifications. Of course, Business Central is my specialty, but I'm also certified in Azure, CRM, finance and operations, and Power Platform. And I'm studying to get more certifications. Right, so inventory cost accounting. Let's start with the first, let's say, quick introduction, because cost accounting, if you're not an accountant by trade like me, it might be quite counterintuitive. So inventory cost accounting is the process of assigning costs to the goods that a business holds for sale or production. This is important because it's about assigning a cost to what an organization essentially consumes or ships. It's more about the outbound process of inventory. So cost of goods for sales or production, right? Includes also purchase price and other costs, and like insurance and handling. And this is where we're going to cover direct and indirect cost, right? Inventory cost accounting, therefore, it's not just about the purchase price or the standard or the average price cost of the item for inventory valuation. It's mainly, arguably, the most important part of cost accounting. It's the cost of sales, the goods out part. These costs are then used to calculate the value of the inventory that a company holds and it's stored in the balance sheet, but also on the subledger. We will see that in a moment. And the cost of goods sold on the income statement as goods are essentially shipped or also consumed or even adjusted, right? So inventory cost accounting, therefore, is about storing, assigning the cost to the goods when are received, managing and updating and maybe revaluing these costs when goods are stored, and then using this cost to calculate gross margin when items are sold, essentially. So what are the characteristics of inventory cost accounting in Business Central, but also overall? The unit cost in Business Central determines the cost of the item. It's unit cost, and it's always in the local currency, regardless of the currency in which you transact the item. The costs are passed from inbound to outbound documents, or in some cases, if you look at Microsoft Learn, sometimes Microsoft refers to this application cost as inventory increase to inventory decrease. And this is because you can see it here on the screen. You have closing entry, applied, increase, and decreased, right? So When you can see here, the frequency of the update is controlled by the global setup. So the global setup, which again I will show you that in a moment, controls when and how often the update of the cost from inbound to outbound happens, because it doesn't always happen in real time. It is ideal that this update, this frequency happens in real time all the time. But again, sometimes there are downsides of doing that. Business Central is now a lot more powerful than what it used to be. And of course, compared to Nav, it is incredibly more powerful and a lot faster. Therefore, disabling the automatic update of inventory cost update might not be necessary anymore. Which means if you enable the automatic cost posting and automatic update, you essentially reduce almost to zero the risk of getting costs wrong. So here you can see in this screenshot a typical cost calculation overview. Forget about the fact that it shows average cost calculation overview. It's just terminology. These numbers are used to calculate the average, but really, if you check line by line, it's always the actual cost. So an inventory increase and inventory decrease means an increase is a purchase. You can see, and then we have a decrease, which is, again, a sale, consumption. We also have an application between two transfers, because transfers work in a slightly different way. You have an applied increase and a decrease when you transfer items across locations. The cost is always updated, even through transfers, but the application is managed in a slightly different way. But this should give you really the foundation of inventory cost accounting in Business Central. Every inventory movement in Business Central affects the cost. Doesn't matter if the cost is updated or not, because as you can clearly see here, it can be the same or it can be different. But every inventory transaction that does not apply to warehouse transaction. So a transfer between location A and B will log an entry in your cost, essentially. A transfer between two bins in a warehouse location will not do that. So something to think about when you're trying to configure inventory management for your clients if you are a consultant. So how does this movement of costs, monetary amount, flows from one place to another? How does that flow from one place to the other for inventory increase to inventory decrease? Business Central uses a set of ledgers to do this job. So the first one is the item ledger entries, which is essentially our Business Central inventory subledger. So if you are a consultant, if you are a user, if you're not an accountant by trade, and you try to explain this concept to your colleagues or clients, and you are talking to someone whose job is about, again, finance or an accountant, use this terminology. Item ledger entries are inventory subsidiary ledgers or subledgers. This is the ABC of accounting, and anybody with an accounting background will understand. I always use it for training purposes. So it's an inventory subledger. It only stores the inventory increase and inventory decrease, up and down, right? Inventory goes up and inventory goes down. It doesn't do the double entry because, again, it's a subsidiary ledger. Item ledger entries are linked to the general ledger by a posting group. So the posting group determine which nominal ledger or general ledger in your company's or your client's chart of account is used to register the actual cost. Again, balance sheet, income statement, variance, doesn't matter. Everything flows through the general ledger via the posting group, but the calculation, the amount that will be posted to the general ledger is determined or calculated by the value entries. So essentially we have three ledgers: item ledger entries, physical stock, quantity, right? Number of boxes, number of pallets, kilograms sometimes. Value entries, the monetary amount, right? General ledger, balance sheet, and income statement, okay? So where can we see this in actions in Business Central? In a moment, we're going to look at how it works. You might be familiar with these concepts if you are a consultant, but it's always good to have a refresher before we dive deep into Business Central, right? So item ledger entries affect physical inventory. You can see here item ledger entries, -2, -4, +500, right? And it's always by location, by item, by location. Again, the item ledger entry does not look at bins, zones, because that is not physical inventory, right? Value entry is calculated cost amount and the cost type, whether it's expected or actual, direct or indirect. Again, we will see that example later. And the general ledger is essentially updated by the posting group, right? So, next one. As I told you a moment ago, one of the two cost types can be expected, another can be actual. So expected costs are always calculated and stored on the subledger in Business Central. This is also a common misconception. Enabling expected cost in Business Central enables some additional features, but the expected costs are always stored at subledger level. Expected cost posting does something more. It just writes the expected cost to the general ledger. But if you don't enable it, you can still see the expected cost on the subledger only, right? So what are the expected cost posting? If you enable it, you end up with your goods shipped, not invoiced, in your cost of sales, usually an interim cost of sales. Goods received, not invoiced, in your balance sheet inventory. Again, it can be an interim balance sheet. And also goods manufactured, not finished. But when you post output, before you close the production order, before you finish the production order, expected cost posting will post to the inventory accrual in the balance sheet before you finish the inventory, the order. So something to keep in mind when you design expected cost posting. And here is an example on the item ledger entries. You can clearly see cost amount expected, cost amount actual. The cost type and amount are on the subledger, on the item ledger entries. The costs are always updated when you post the invoice. So in case of a shipment, when we ship items, the expected cost of sales is stored. When we invoice the sales order, the cost is moved from cost of goods sold expected to cost of goods sold actual. The same on purchase, right? The posting setup in Business Central allows you the separation. It is very important because if you look at Kronos, the Kronos database, most of the time expected cost and actual cost post to the same ledger. And that is okay if your client, finance manager, finance controller want that kind of setup. But in some organizations, they want to keep the things separate. Again, something to ask and to discuss with the finance controller of your organization, your client, because it's not something that you can just decide as a consultant, right? Because it will affect essentially the company books. So now that we covered expected cost and actual cost, then we have an opportunity to look at another type of cost, which can also be expected or actual. So you can see how the Business Central can manage a lot of complexity here. Direct costs in accounting terminology, in accounting terms, direct costs in your inventory are costs tied to the purchase and handling of individual items for the individual transactions. Example, insurance, custom duties, freight, right? Those are direct costs. We also have in Business Central indirect costs, and indirect costs are expenses incurred throughout the inventory management process. It can be repacking, it can be some relabeling, for example, items that you don't really apply to a specific item or purchase, but those are costs that are expensed throughout, I don't know, maybe a month or a few weeks that you just want to spread across the item. In Business Central, we manage that through two specific different features. Direct costs are managed through item charges. And here you can see the value entry, the ledger, the register that stores the valuation, or the amount related to inventory transactions that we need to post to the general ledger. And here you can see that there are value entries specifically created by item charges. Here we have a direct cost of purchase for a freight charge purchase, and you can see it looks at the cost amount actual and the cost amount actual of the item charge plus the direct cost of purchase, the price, the amount that we paid to the supplier, or in Business Central terminology, the vendor, will be summed up. And the two together will make the value, the cost of my item, right? So this is the direct cost. But indirect cost or indirect costs in Business Central are also a type. And you can see here another example of value entries. In this case, it's a preview for an order that I didn't post. We have a purchase indirect cost of $10. I believe this is a US sandbox. These are usually accrued on receipt of the item, and they are managed through an overheads applied, which is then reversed at the end of the month. Typically, it's part of month end, but it can be done as a regular process where we get the actual costs. It can be a timesheet, it can be a payroll, the number of hours spent by personnel doing some kind of rework. It can be a purchase invoice from a subcontractor, in which we reverse the accrued overhead applied, and we post the actuals, right? We will show you in a moment how that works. So the next part then of inventory costing, now that we have learned about the capturing these costs, creating these costs, and managing costs through overhead applied, landed costs, and purchase prices, we can talk about revaluation explained. So revaluation. Item revaluations update the cost of the item in stock. You can revalue your inventory on hand, and that can be because of various reasons. The inventory is obsolete and you lost inventory value. The inventory has appreciated because of reasons. Again, the organization, your client may tell you why they do inventory revaluation. It's really a finance requirement. But it can also update the cost of sales of items that are already shipped. That does not cover the updating the expected against the actuals. That's something that Business Central does it anyway, if there is a difference, of course, between expected cost of sales and actuals. But it can update the cost of the items shipped and invoiced if we backdate the value, the inventory revaluation. Again, in the demo, I will show you how it works step by step. So stay with me until the end, because we will actually use Business Central. So this is an example of an inventory revaluation journal where I use the create inventory, calculate inventory value job or task to automatically populate the journal for me. And if I backdate the valuation, Business Central will look back in the past, reevaluate the inventory that I had at that moment in time, and if any item that I'm trying to reevaluate after the posting day but before today that has been again shipped and invoiced would also be revalued, which means that the cost of sales will be revalued, which means your gross margin will change. Of course, your organization or your client gross margin will change. How does Business Central do that? By updating the value entries. Remember what I said earlier, the amount posted to the general ledger is determined by the value entries. So any report or analysis that you as a consultant or your client or your organization wants to create to analyze gross margin of your inventory must not look at the general ledger. It must look at the value entries, right? Or it can look at the general ledger, but of course the value entry is the best place to look into it. But of course it cannot look at the invoice lines because the information on the invoice lines will be lost. It's only the value entries that store that information. Okay. We can avail the recording, of course. Sorry, one comment. We can avail the recording session. Absolutely, no problem at all. I'm recording, and I will share it after the after today's meeting. So, next one: standard cost and invariance in manufacturing. Thank you, sir. You're very welcome, sir. Standard cost and cost and invariance in manufacturing takes inventory costing to really its most complex application, where additional features and different and rather complex calculations actually happen. And this is where Business Central differ from other business applications like SAP and Oracle. And it's something I encourage you to discuss with your client if you work with manufacturing companies. Items in Business Central are valued and costed using the same unit cost, right? This is an inventory, and this is a very important point. The standard cost is the same cost used to value items and cost items when you ship and when you sell the items. There will be an inventory variance and a cost variance, which is managed and calculated twice in Business Central. And as far as I know, Business Central and the Dynamics applications are an exception in the business application world, where SAP and Oracle, at least in the EMEA region, work in a slightly different way. But I'm happy to be contradicted here because I'm not an expert on SAP and Oracle. But this is how Business Central works. There is an inventory variance, which is used to reconcile the difference between the actual total cost of production and the started cost posted to the finished goods inventory, essentially to close with work in progress. But there is also a cost variance to reflect operational performance variances as difference between the standard cost and labor absorption and material consumption. We will see that in action, and then next month in another workshop, we will go through standard costing in manufacturing, and we'll spend the entire hour talking about standard costing for manufacturing companies, which is rather complex, and it requires a dedicated workshop. So I will send you an invite anyway. I will share it on LinkedIn if you are interested in learning that too. It's going to be rather advanced, but again, if you really want to learn it, I encourage you to sign up for that. So here is an example of standard costing manufacturing variance. It's calculated when the production order is finished. But on the production order statistics page, Business Central shows you the variance. And you can see this is an example of a production order that we will use in a moment in the live demo, where I have variance on capacity cost and capacity overheads, where I essentially doubled the amount, my cost, just to give you an example, right? This is an unlikely scenario where we have double the capacity cost, but I just wanted to show you how it works. So Business Central shows the variance on production orders that are still not finished, but you will not get the variance in your books in the general ledger until the order is finished. So something to keep in mind if you're building reports and you want to see the variance on production orders that are still not finished, right? Things get a bit more complicated, but again, more on that in another session. So enough of PowerPoint and enough me talking. It's time to get busy looking at and working in a sandbox. All right. So as I said, I'm recording the session, so you will receive it via email. Feel free to follow along, open your sandbox, and then follow through. I'm going to use a Kronos database, and so we can work on it together. So let me log in and let me change my screen so we can look at another company. So let me go. We're going to look at, going to stop sharing, and I'm going to reshare. There we go. Now I'm sharing Business Central, so we should be able to follow through. Right, I need to get my notes on my screen because there's a lot of stuff that I want to talk about today, so I need to follow through using my notes. Right, so expected cost posting is the first thing that we're going to look at. So expected cost posting, as you might know already, is enabled on the inventory setup page. And it's driven by this field here, expected cost posting to the GL, right? Once this one is enabled, we need to ensure, and this is where we're going to look at the posting, that a couple of fields, very important, because if you don't enable that, if you don't set that up, you won't be able to post. Expected cost posting is managed in two places. In the inventory setup page, inventory posting setup page. And on the inventory posting setup page, the inventory account interim is the inventory temp account, temporary account, accrual account, regardless of how you want to call it. Goods received, not invoiced, will go to the inventory interim account. And so here we're going to set up a East resale, and you can see I have 14145, which looks at inventory accrual. It's a balance sheet account, and it's not the same as my 14130, which is finished goods. So this is the balance sheet side of the transaction. But as we all know, in accounting, there are always two sides of every entry. The other side, on the general posting setup, it's what accountants called goods received, not invoiced, which is usually, it's a liability in the balance sheet. It's inventory accrual account interim. Don't ask me why Microsoft decided to call it this way, because every time I show that to an accountant, they told me I got no idea what that means. Right. Inventory accrual account interim is your goods received, not invoiced. Right. On the shipment side of things, we have the cost of goods sold account interim, right? And of course, the balance sheet side is the same. So what we need to do now, we need to ensure that we have, let's say let me see, I have domestic and retail, and I have here. So domestic and retail is correctly set up, and East and resale is correctly set up. So what happens now if I create a purchase order? I'm going to create a purchase order. We're going to do it live. So there we go. And so I choose an item. I'm going to choose my artist's desk, which I know I can use. And we're going to receive it in East. And I'm going to buy 10 of these, right? This is direct unit cost. And just to round it up, let's say it costs me $500. Okay, we round up the numbers so that we show how it works. Expected cost posting means I don't need to get a vendor invoice. The moment I receive the item, and I'm going to do the posting, oops, wrong one, post, and I'm going to receive only, Business Central will post the expected costs, because again, we don't have the actuals until we have the invoice. And where are these costs stored? Well, on the balance sheet, item ledger entries, but also value entries. So if I look at the receipt, which is a posted purchase receipt and I click on Find Entries, this is where the two subsidiary ledgers and the general ledgers are going to be linked to, right? And here we can see it. I see the item ledger entry, remember the subledger. And what do I have? I have cost amount expected. Again, expected cost. This 5,000, if I drill down here, looks at the value entry, which is a purchase receipt. It's a direct cost because it's what I will pay to the vendor. And you can clearly see here how cost amount expected shows here. So you can see how everything is coming together. So, and the general ledger entries now show pretty much what I showed you earlier. 14145 inventory accrual, 22210 goods received not invoiced, right? Which is inventory account accrual interim in the general posting setup. So that's how it works. What happens when we get the invoice from the vendor? When we get the invoice from the vendor and I post it, I'm going to invoice it. Now I'm going to get this invoice. I want to see it. And on the invoice side now, I see the other side of the inventory costing. It's the actual. So I don't have an item ledger entry here because, again, I don't want to double count my inventory, right? It's been already accounted for. But the valuation, again, the calculation that Business Central does to determine the cost now tells me that the cost expected is being reversed and the cost actual is being posted. So the total of the two transactions is balanced, right? And so you can see how that works, right? The general ledger entries now look a bit more complicated, but the most important thing is this one. These two. We have the reversal of inventory accrual minus 5,000 and the posting on of finished goods. So I got zero balance on my inventory accrual. I got $5,000 on my inventory actual. The rest is pretty much taxes and accounts payable and other stuff, right? So on the sales side is exactly the same thing. So I'm not going to repeat the exercise again because it's exactly the same thing, right? So this is about expected cost posting. The next one is about direct and indirect costs, where things get a bit more complicated. Right, so let's look at the item card because the first thing that I want to show you is the indirect cost setup. The indirect cost setup is stored overhead rate in the overhead rate field. So if I filter my item list using overhead rate not equal to 0, right? Overhead rate, there we go. I think I might have that in another one. Let me see, actually, let's apply that to this one. Indirect cost, sorry, not overhead rate. My bad, my mistake. Indirect cost percentage, right? So indirect cost percentage is where we store the information about how much as a percentage of the item cost the system must accrue when we receive this item. And so you can see that it's not something that I can key in and type and update on a purchase document. It's accrued based on a percentage. In this case, it's 2% of $50-something, right? So what happens if I look at a purchase order? Let's see if I have a purchase order already created for this one, or we will create one. No, not this one. Right, so let's create a new purchase order. And I'm going to receive the item again from Fabricam. And it's going to be my plywood chair. I'm going to receive it in my main location. And I'm going to purchase 10 of these, right? And you can see direct unit cost is $50 each. and total is 500. Okay, so I'm going to put an invoice number here because I will show you what happens here. The difference between a direct and indirect cost in Business Central is that if I received only the item, let's look at orders, let's look at receipts, and let's find the entries. You would expect to see the indirect cost next to the value entries, next to the direct cost. Unfortunately, indirect costs in Business Central are not accrued on goods received, not invoiced. So it's a limitation, right? It doesn't do that. And you can see that everything is rolled up into one place, right? So the cost is correct. It's 50, plus the 2%, the cost per unit, but you don't see the split on expected cost. So a limitation, but again, your numbers are always correct. The item ledger entry, cost amount expected, it's not looking at 500, it's looking at 510, right? So all good so far. I mean, all good with the limitation, which it's not typically a big deal, but that's how Business Central works. So keep it in mind if you're working on a new project. So no posted invoice, which means now we're going to post the actual invoice. I'm going to receive an invoice. And now the interesting part is that once we get the actuals, you will see the two value entries. And this is where things gets really interesting because you can clearly see the indirect cost now being split. And so you can see the reversal of the 510, which was the accrual, the goods received, the expected. But again, the entire amount expected, it's reversed into two entries, direct and indirect cost. And so the direct and indirect cost now, you will see the £10 be moved to finished goods, reversed from the, and they go into a goods for resales. You can see it's being reversed from this one, inventory accrual. It goes into these two. So what is the balancing entry of this overhead applied? Again, it's here in the general posting setup. In the general posting setup, my overhead applied, my indirect percentage goes to overhead applied account. There we go. This is the one that is going to be used. And so it says goods for resale 14140. This is Kronos. I would never call this account in my balance sheet as goods for resale because it's very confusing. So keep it in mind, Kronos database for finance, posting, configuration. Take it with a pinch of salt. There are lots of things that do not apply. Some are just plain wrong. But again, just a terminology, right? You can see how everything works. Right, so expected cost posting, direct and indirect. So if it's overhead rates, overhead applied are indirect cost, how do we manage direct cost? Well, direct costs are managed through item charges. And item charges are something that we use on purchase documents. Less common to use it on sales documents because they work on a different way on sales. It's mainly about purchase and essentially applying an additional cost to the item, which can be a purchase allowance, right? It doesn't have to be physical stock. But let's stay with this one. Another thing that in Kronos is wrong, and you should never copy the setup. You will end up in trouble because it's just plain wrong. The general product posting group, it's never going to be the same that you use for services because the posting is completely different. I have created a dedicated product posting group called Freight. And on this product posting group Freight, you don't really need anything here. You only need a couple of things. You need the purchase account and the direct cost applied account. Direct cost applied account, oops, this one. will balance the balance sheet side of the freight, the landed cost, and which will go to the same balance sheet as finished goods. And the purchase account will balance accounts payable, because as a direct cost, the freight, the item charge, is something that we have to pay to a supplier. It can be the same vendor of the item, or it can be a third party. So you can see the difference. Direct cost on item charges is something that we must pay to a vendor. Overhead applied are essential overheads that we accrue, and then we reverse when we need to. So let's look at the purchase order, and let's see what we can do on this purchase order. Let me see if I have also created something here. Fabricam, this might be the one. There we go. So in preparation for this demo, I created this order, and you can clearly see I am buying the same item, my chair, my location main. I am buying 10 of these, same cost, 50. Remember, we have the overhead applied, so it's 51 per item. But I also have a charge of type freight, which is applied, because now we need to apply it through the item charge assignment. Here you can see, in this case, it's very easy, one charge to one line, and so it's only one line here. Everything is applied. So the 10 US dollars are applied to the chair, right, that I'm buying, okay, to the chairs that I'm buying. So what happens when I post and I want to receive only something very similar to the accrual of the overhead rate? Because in Business Central, the direct cost of linked to the item charge are also not captured at all. You can see here we have the direct cost of purchase and indirect in one place accrued here. But if I look at the item ledger entry, again, 510, I don't see the item charge, right? So keep that in mind, because there are extensions that do that. There are extensions that can accrue essentially and post a landed costs on receipts, but you need to get that extension. Standard Business Central doesn't do that. So again, discuss with your clients if they need that. Better get an extension in AppSource. Trying to develop something that does the job is very difficult. So I'd rather get an extension, because the job is pretty much done for you. So once we are ready to get and post the invoice, it's where we have the application of the item charge. And so if I look at the entries now, you can see 3 value entries. You can see we're taking the complexity to the next level now. We have direct cost of purchase, expected 510, reversed with 500, 500 cost of purchase. We have indirect cost, which was essentially rolled up into 510, which is now separate. But we also have the purchase invoice of another direct cost, and this time is linked to the charge with the $10 correctly, showing here. What happens to my general ledger entry? Now we have a lot of additional stuff, but again, it's pretty much what we covered earlier. If I look at my inventory accrual minus 510, which is being reversed, and then we can have these goods or resale overhead applied balance sheet. Again, goods for resale Kronos data, don't look into it. The indirect cost that goes to my balance sheet, finished goods. The 500 cost of purchase goes to my balance sheet, but also the same account, finished goods, gets £10 of freight charges that are capitalized and balanced by an entry in my income statement, right? And now you can see my, where is my accounts payable? My accounts payable should be the sales, and so cost of material, and again, accounts payable should be somewhere here, right? Where essentially we need to pay, the right amount to the client. okay, to the vendor. So a bit of complexity here, but hopefully you're following along. So let's look at inventory revaluation, because I show you that inventory revaluation is one of those tricky elements. I wouldn't say tricky. It's one of those, I would say, rather powerful features in Business Central, because as I told you, you can use inventory revaluation for two purposes: revalue what you have in stock only, or you revalue what you used to have, right? Because you can backdate it. Doing that will allow you to revalue cost of sales. It doesn't apply to expected cost posting, because expected cost posting will always update inventory on invoicing. It does revalue, again, your inventory evaluation can revalue goods invoiced. So sometimes you want to do it, other times you don't want to do it. So let's start with an item revaluation journal. And here I'm going to guide you through an example. This is an example that I created earlier, but I'm going to clear it. I'm going to delete it because I want to start from scratch. I want to show you that how it works when you start from zero. Right, so no entries, item revaluation journal. I could key in stuff here, but really the best way to do this is to let Business Central calculate the inventory value for you. You always get this warning that says to make sure that all the items are adjusted before you start, you should run the adjust cost item entries batch job first. And that's because Business Central does not look at the setup, unfortunately. If I look at inventory setup here, you can clearly see that automatic cost adjustment is on always, right? And automatic cost posting is on, which means Business Central, so my inventory valuation, is always updated. My costs are always updated in real time with every transaction. There's no need to do anything else. There is no way that the system can stop updating costs if you let it run on autopilot every time. If there is an issue with your cost, you will see it when you ship the item, and it will tell you the item cannot be adjusted because reason. So it's the safest and best way to manage. True, it slows down the system, performance are a bit affected, but again, in version 26, I have clients posting hundreds of transactions per hour, never had an issue. So my preferred way of working is you want to eliminate headaches, you want to ensure your costs are always correct, leave this on and let it run automatically. Developers might disagree, but developers are not accountants. Developers don't work in supply chain management, right? Right, so with all due respect for developers. So close parenthesis, let's go and calculate inventory value. Do you want to continue? Yes, I do want to continue because my inventory is always up to date. I don't need to do anything else. So I'm going to do the inventory posting as of today. Actually, I believe my date in my sandbox is the 5th of May. So I'm not going to do it in the future. I'm going to do it today, 5th of May. So I'm going to have a demo 01. And I want to find my Washington plywood chair. And I want to get only the location East because I know I've got good data here. You don't have to run it for one location. You can run for all locations. It's just because I got good data that we can use to show it to you. Right, there we go. So what happens here? In location East, we have 11 units of this item valued, right? You can see the inventory value is 11 and it's 50. Units. Again, the 51 cost per unit is for another location because I didn't post in East. That's why Business Central can differentiate. It can show me 50. It's not because it's incorrect, because the cost of the item, as I showed you before, It's always linked to the item ledger entry and value entries, which are always location specific, right? There are exceptions, but again, something for another session. So if I look at this field here, it says applies to entry 684. In this case, Business Central has found the adjustment that I made in location East that was made on the 30th of May. Of April. It's the 30th of May now. Of April. And so it shows that I had 12 in stock. It also shows that I have remaining quantity of 11. So 1 has been shipped. Okay. If I change the value and revalue at 55, for example, because actually let's do something. Let's do 51 because let's say I forgot to use overhead applied, and now my inventory of 50, well, should be 51, like the example I made before. If I do preview posting, I got one value entry, revaluation, and it's really adjusting $11 because again, it's £1 difference for 11 units, but it doesn't update what I shipped because I'm posting as of today. Let me show you what happens if I delete this line and if we do the same, but this time, instead of looking at the 5th of May, I look at the 1st of April. So I go back in time before I actually receive this stock. So demo, and I'm going to do the same, exactly the same, and I'm going to choose East. I click OK, and look, here you can see that difference. Hopefully, I got 12. And so you might say, well, Alfredo, the system is wrong because I only have 11 units of this item in my inventory. Why is Business Central showing me 12? Well, it's showing you 12 because it's looking at the 1st of the month before. Well, when at that time we had 12 units, still valued at $50 each, and it's still applied to 684, but you have 12. It still tells me that I have remaining 11, but if I look at the applied entries, because I see there is a sales shipment that consumed one piece of the item from my location East, the shipment was posted on the 5th of May, and it's been invoiced, okay? And you can see, because it's not open, okay? So, because the revaluation happens before the shipment, if I now check 51 and I do the preview posting, now I've got double the entries. And you can clearly see that what's going on here. Remember, the value entries determine the amount that gets posted to the general ledger and the cost type. I have a positive revaluation of my positive adjustment. This time is $12, right? $1, 12 units. But I also have another direct cost marked as an adjustment because Business Central has adjusted the cost of sales of what I shipped. And notice how my positive adjustment is logged on the 1st, which is the date of my journal, but it also shows the 5th because of May, which is the date of when I posted the shipment, right? So it's readjusting what I already sold, essentially decreasing my gross margin because my costs are higher, $1 higher per unit, right? And so I'm going to post a journal, and now my inventory is being revalued. All right, excellent. So 5 minutes to go, quickly through a standard costing, just an introduction, because as I said, it's very complicated. So let's look at the released production order, which I created before. And I used a very simple item that I just created for this exercise. My Newcastle coffee table. My production order is very simple. I have one coffee table to produce. And if I look at the, let's say at the item here, if I look at the order statistics, you can clearly see what happened. I have a standard cost of $11 for my item. Sorry, a total cost of 12, not 11, sorry, right? Which is very simple. It's made of $11 of material and $1 of capacity, split in 76 plus 24, capacity and overhead, okay? So very simple scenario. These are the expected costs because nothing happened between the standard cost and when I created the production order. But I also have a variance, and it's 100% variance on labor. And you can see that the variance is registered here. I have double the labor and variance because in my capacity ledger entries, instead of having 2 hours of, 1 hour of this machine, which is set up on the item, I had to use 2 hours of the machine, right? It's a variance. It took me longer to complete this order because there was something wrong with the machine. So I had to use 2 hours instead of 1. And as a result, you can see direct cost and overhead now, it's amount to double. It should be $1, it's $2, right? But what happens to my item ledger entries now? You can see I have consumption of material and I have an output that looks at 12, right? So the output is calculated at 12 pounds. Dollars. It's amount expected. It does not get posted to the general ledger. Okay, so you can see unit cost and unit cost amount. So with essentially the variance, you can see the total cost is 12. So my item is valued at 12, which is standard. My actuals are 13. So far, it's fine. We don't have variance and we don't have the actual. So when I change the status to finished and I ask the system to update this unit cost, I get more about this one because sometimes you don't want to use it. But again, it's more complicated. We will look at that another day. Now, when I look at my finished production order, we will see the 2 variance amounts being posted. There we go. So this is my item, still shows a 12 because it's the standard cost. So if I look at my item ledger entries, I can see the consumption at 11, the amount at 12. So fine, standard cost 12. Where is the variance? The variance is here and is calculated twice. So you can see it's the expected cost not posted to the GL of 12, standard cost, is reversed, and now I end up with $13. So my inventory, even though the item is a standard cost, the entry is at actual. The actual, though, is balanced by 2 inventory variants, and so my inventory, my balance sheet to reconcile, uses inventory variants that are posted to the balance sheet. Very uncommon, as I told you, SAP and Oracle don't do that. Discuss this with your client because in some cases they might object to that. And I had an example a few months ago. Eventually, by looking at the other entries, you can see that the value entries that look at the variance, you can see how they work here, and the direct cost and the cost of output, which is essentially is balanced here. So this is where the variance on your income statement is calculated because you have the actual, right? And so you can see here the consumption. So the variance on labor is calculated here. The variance on the balance sheet it's here. So you can see this is a bit more complicated, but again, if you need help, if you want to learn more about that, next month we will go through standard costing in manufacturing, where we can cover the ins and outs of standard costing for production and manufacturing, where Business Central, and I believe also Dynamics 365 Supply Chain Management, work in the same way. But again, I might be wrong. For sure, SAP and Oracle don't work in this way. So if you have a manufacturing client, discuss that early with the finance controller, the finance manager, because that might create some misunderstanding. And then, of course, you'd want to clear that as soon as possible. Right, 1 minute past 8:30. So I managed to go 1 minute over time. So apologies for that. But we have 29 people online, which is great. So I can stay online if you got a few questions. If you haven't got any question, it's perfectly okay, because as I said, the video is being recorded, and so I'm going to edit it. And as I said before, I'm not going to include your personal details here. So I'm going to hide your name and your personal details here, so don't worry about that. And so you can actually watch the recording later, right? And so if you got any question, you can actually get it right. There we go. Lawrence, no problem. Let me unmute you. Yes. Oops. Yeah, you should be able to unmute yourself.
All right. Thank you so much, Alfredo. I really appreciate these sessions. They really help me to keep up with the speed. And my question is a bit related to the practical environment where I work. I deal with an NGO organization, and in NGOs they don't take stock or inventory as an asset. They really don't do that.
Right.
Reason being, they believe that money belongs to the funders. So I have only one problem with that. When they purchase and receive an item into their stock, they want to issue that item immediately to the end user for the project to continue. However, we've noticed that when you receive before invoicing, the system captures the cost as expected cost amount.
Yes.
So we've been having a problem of negative inventory valuation, which I've really tried to find a solution, but kind of hard. And I don't know if you can be able to advise on that. I don't know if it's because of receiving and not receive issue before you invoice. Yeah.
Well, Lawrence, yeah, absolutely. Thanks for that. So a couple of things. If it's project-based accounting, that works in a different way. You want to use projects. The moment the item is received, is immediately issued, and therefore it's expensed on project. But you don't want to use purchase orders and purchase receipts. You want to use projects. That's already, that Business Central does it already. And so what you described to me is project accounting, which is covered by Business Central project in the project module. If you don't want to use projects, you can disable expected cost posting. And so you will not end up with the expected cost, which means that when you invoice the item, you receive the purchase invoice, you also want to ship the invoice and invoice it to the end client. And so your inventory will always reconcile. But again, feel free to send me an email. We can talk about that, more extensively, because project-based inventory costing is different from purchase and consumption. It follows different rules that we didn't cover today. So again, thanks for sharing. And again, feel free to send me an email and we can discuss that. Excellent. We have a question, Mohammed. What is the cost estimator for the item we used for item evaluation during the session? I used standard for the Newcastle item. Sorry, for the inventory evaluation, it was FIFO. First in, first out. That's what allows you to do that. First in, first out is the closest as to an actual, recording an actual, and therefore it does the evaluation for you. No problem at all. Excellent. I see no other questions, so maybe, oh yes, one more. Virtus, yeah, you're typing, no problem. I'll take your question. I can stay online. Again, feel free to write your questions in the chat or raise your hand. I will allow you to unmute yourself. No problem at all. Left the chat, okay. I can see you're still typing. I'm not sure if you have a question or maybe you type it in another chat. You're working while you're watching the webinar, which is okay. Of course, I'm just joking. No problem at all. So as we wait for Virtus to write it, there we go. Does the inventory period affect valuation? The inventory period does not affect valuation in terms of the actual value. Inventory periods allow you to define where and in which date you can value and revalue and update the valuation of your inventory. So it's a good question because I didn't mention that. We have inventory periods in Business Central as well as financial essential periods, right? Your months. Closing an inventory period does not stop you from posting because that's determined by the general ledger setup, right? The general posting setup, I mean. So the closing inventory period means that when you're trying to revalue stock and you're trying to backdate it, Business Central will look at the closed inventory period and will forward the posting date of the revaluation to the earliest date in an open inventory period. So you can still revalue your stock, and because again, costs are supposed to be about inventory received, inventory, and outbound inventory shipments, but the inventory month determines whether you can post in one period inventory valuation or not. Another question, do we use item revaluation journal with the item costing method is average? You can do an inventory valuation when the costing method is average. I did that a couple of months ago for a client that went live, and they went live with average costing method, and the opening balance was incorrect and it was all wrong. And they found out about that a week later after they have shipped a lot of items. So average works in exactly the same way, right? Well, for revaluation, it doesn't work in the same way because it's a different costing method, right? But you do the item revaluation in the same way. You can backdate it, right? You do it per item ledger entry or per item, and we'll just do the job for you, okay? You're very welcome. Right, 9 minutes over time. If there are no more questions, we can close it here. You're very welcome. Thanks everybody for staying online, and I hope you find it beneficial. Please feel free to share your comments on LinkedIn. Give me some feedback. Give me a recommendation if you want. That will really help, the algorithm, and help, sharing my profile. That would be ideal. As I said, give me a couple of days. I will polish this video, the video recording. Polish. I meant I will edit it so that your names or your personal details don't show on the recording, and I will send you an email. Send an email to all of you with a copy of the recording. You can download it, you can watch it, you can share it with your colleagues. As always, again, feel free to send me an email if you've got any question. Follow me on LinkedIn. Until next time, have a great rest of the day.